Hello, everyone. My name is Arnold Machel, and welcome to another Visionvest Live Digital Discovery broadcast. Today is Tuesday, October the 19th, 2021. And Ben Machel, my son, will be covering the use of Registered Disability Savings Plans, or RDSPs for short. Now, we are recording this session, so if you miss a detail or you want to go back, or if you want to pass it on to others later on, you will have the option of doing that. If you have any questions or any technical difficulties, please let us know through the live event Q&A feature. If you look at the top of your screen, just slightly to the right of center, you'll see a little bubble with a question mark inside it. By clicking on that, you'll have the option of entering in a question, or like I say, letting us know if you're having technical difficulties. I do understand there are some people who had some technical difficulties getting even on this site, so obviously you wouldn't be able to use that feature. We'll do what we can to get you on right now. We will do our best to answer all the questions at the end of the webinar, and we'll try to help you out with any technical problems immediately as they arise. But if a question gets a little bit too technical or specific, we may deal with that offline and reach out to you separately. RDSPs are incredibly amazing vehicles. They're the most generous and the most complicated government plans available. And Ben is our RDSP specialist here in the office. Today, you will hear him talk about who's eligible for them, how they can be used. You'll also hear how to get the most benefit out of them. Of course, if you've got one through us, then we're already making sure that you're getting the most out of them that you can. Having an extended family member who's eligible for an RDSP was a really big motivator for Ben wanting to fully understand their use. He recognized immediately what a wonderful tool they were for those who are eligible for them, and like me, was dismayed at how few eligible families have taken advantage of RDSPs. Ben's been working with us here in the office in the financial industry for over 5 years now. He's excelling in every aspect, having recently obtained his CFP designation and assisting us in the purchases of another practice. He's exhibited all the hallmarks of top advisors in the industry. I'm sure that today you will find the webinar both entertaining and valuable. Over to you, Ben.
Excellent. Well, thanks so much for that introduction, Arnold, and thank you everyone for joining us today for our topic on the Registered Disability Savings Plan. Every time I think about or I talk about RDSPs, as Arnold alluded to, I'm blown away by how impactful and how beneficial they can be for people living with disabilities. And yet very few people seem to be aware of them or to fully understand the benefits. As of the last count, only about 24% of those eligible have actually opened one, meaning that hundreds of thousands of disabled Canadians are leaving free money on the table. So that's why we thought it would be a great idea to bring some attention to the plans and go over the benefits and discuss using RDSPs as long-term planning tools. So as we go along, if you think of anyone who might possibly benefit, you might be doing them a huge favor by passing on a link to this webinar. As Arnold said, we'll have a replay available, or I'm always happy to discuss any individual situation by phone or email. So with that, we'll jump right into it. We've got a lot of ground to cover here. So I'm going to start first off with who's eligible to receive the disability tax credit, which is really one of the primary considerations for eligibility for the RDSP. We'll talk about sort of who can be the account holder versus the beneficiary, all that sort of stuff. Then want to chat about what the benefits of opening an RDSP would be. Most of that comes from the free government money on the table, but there are some other benefits as well. We will talk about what contributions you need to make, if any, to get that government money in there, and sort of what catch-up room would look like if you've missed some years prior. And then, as I mentioned, they're intended as long-term plans. So I do want to talk about what future withdrawals will look like, how the taxation of the plans work, all of that. There's quite a bit of detail here. So we will have a question and answer period. If anything comes up, please put your questions in the chat to the right. So yeah, first of all, eligibility for the RDSP. There are actually only a few criteria to be eligible. Those are that the beneficiary has to receive the disability tax credit, or the DTC. They must be under the age of 60. and they must be a Canadian resident with a valid social insurance number. So if all of those things are true, then the beneficiary or someone is able to be the beneficiary of the Rdsp. As I mentioned, I'll talk shortly about the beneficiary versus the account holder. But one thing to keep in mind for now is that the beneficiary can only have one Rdsp. You can't have multiple Rdsps here and there. If you already have an Rdsp and you open a new one somewhere else, you have to transfer the money from the old one and the history, and the old one has to be closed. And at the same time, within the Rdsp, there can only be one beneficiary. They're individual plans. You can't have multiple different people. So really one beneficiary per plan and one plan per beneficiary is how they work. So when it comes to the Rdsp, as I had mentioned, sort of the disability tax credit is the primary criteria for whether or not you're eligible. Really, this webinar is about the Rdsp, but I wanted to touch on the disability tax credit as well. It's got some other benefits that are worth noting. So first of all, it is a tax credit. It's in the name there. So it's a reduction in your income tax payable, and it also allows for extra medical expense deductions on your taxes. So even if the disabled person themselves is not earning income or paying tax, if they're dependent on a family member, then that person may be able to claim the credit on their behalf. And it's worth just shy of about $1,300 this year, and the CRA generally backdates it for the past 10. So, it could be something worth in the range of 10 to 13 grand for someone right off the bat, just for getting the disability tax credit. At the same time, then it's also going to open the door to other federal programs like the Canada Workers Benefit. There's a disability portion, or the Child Disability Benefit. So it can be well worth it to apply for the DTC, even beyond the Rdsp considerations, but the Rdsp itself, very, very worth it, very worth looking into there. In terms of then who is eligible for receiving the disability tax credit itself, who qualifies for it. Basically, you have to have, there must be a physical or mental impairment, and it must have lasted or be expected to last at least 1 year. Okay, so more specifically, they have laid out that blindness explicitly qualifies you for the disability tax credit, or if you were receiving life-sustaining therapy, and that has to be fairly frequent, it must be at least 3 times per week and an average of at least 14 hours per week, or other than those two, if the beneficiary has great trouble with the daily living activities, then they may qualify. So they have to be markedly restricted in one daily living activity, meaning they really can't do the activity at all, or if they are significantly restricted in 2, meaning they have great difficulty all or substantially all of the time, right? So those daily living activities themselves, those are speaking, feeding, bowel and bladder functions, walking, dressing, and mental functions necessary for everyday life. So again, if the person in question can't do one of these at all, or has a lot of trouble with 2 or more of them, they may qualify for the disability tax credit. So what that ends up meaning is that a whole lot of different conditions may or may not qualify, often depending on the severity. A lot are very clear. If someone can't walk at all, they're disabled for the purpose of receiving the DTC. Others are a little harder to say yes or no, this condition qualifies or not. But many of the common ones would be digestion disorders, cognitive issues, breathing disorders. I've heard of many, many things qualifying. We've heard of depression or ADHD even qualifying, depending on the severity again. So to go about actually applying for the credit, step 1 would be to go to your doctor and tell them that you want to apply for the disability tax credit. And they should be able to take care of filling out form T2201 on your behalf and submitting it for approval. Sometimes it's a little trickier than that, though. Not every doctor is super familiar with it. You may need to talk to a specialist for your condition who has likely applied for the credit before. And sometimes you may have to even make the case for why your condition should qualify you. So to that end, I've included a phenomenal tool here, which you should definitely check out. Basically, this is a diagnostic tool that you can go through in your browser. If you just type in disabilityalliancebc.org/DTC-app. And so this is a tool that you go through in your browser, and it gives you sort of a tool. You fill out information about your disability. It'll ask you some yes or no questions and some descriptive questions. And after you go through it, depending on your answers, it'll tell you either no, we don't think you qualify for the DTC, or yes, we think you might. And if so, it even then generates a personalized letter to your doctor, which you can go and edit. And it says, hey, I think I qualify for the DTC, and here's why, bing, bang, boom. And you can get a copy of the form T2201 from here as well, that you then bring to your doctor and make it really easy for them to fill out on your behalf. So highly recommend that you do check that out. We'll be posting that link in the chat here. So applying for the DTC, it can be a little bit of a hassle at times, but it's well worth it. And they've actually expanded the DTC eligibility earlier this year, especially in the areas of mental functions and life-sustaining therapy. So even if you've been denied before on those grounds, it may be worth checking if you qualify now, because thousands of additional Canadians do where they wouldn't have last year and beyond. Okay. So moving on from then the disability tax credit and back to the Rdsp, wanted to talk about who can be the account holder versus who is the beneficiary. Obviously, the beneficiary is the disabled person, right? And so if that beneficiary is a child, obviously they can't go out and open an account on their own. That's going to have to be the parent or the legal guardian who opens the account on their behalf. For an adult beneficiary, then, it's going to actually depend on their mental state, because if the adult is mentally competent, obviously they're going to be able to go and open their own Rdsp. They are going to be the account holder. In the case where the adult has been deemed not contractually competent, well, now someone else has to hold it. It's going to be a guardian, an agency, or another institution legally authorized to act on their behalf. So usually we see that coming through in the form of either a power of attorney or a legal representation agreement. Okay. There is then a third case where the government and the Employment and Social Development Canada, they've recognized that sometimes a disabled person isn't necessarily super competent, but they also haven't been set up with someone to legally act on their behalf, and it's a bit of a gray area. So they've been, or they have introduced sort of a third category here where the adult beneficiary's contractual competency is in doubt. Okay, and so in this case, they've allowed for a qualified family member to actually be the account holder and open up the account on their behalf. A qualified family member would be someone who lives with the disabled person, and it has to be a parent, a spouse, or a common law partner. So unfortunately at this time, they're not counting siblings as qualified family members, even if they live with the disabled person. That may change in the future, but for now it's just a parent or spouse or a common law spouse. Okay. One other thing to keep in mind in terms of who can be the account holder is that if you're thinking about the case of a competent adult, but it's perhaps your child, and so let's say it's your 20-year-old child who is competent, if they're setting up the account when they're 20, they're going to be the account holder. You can't really help too much. If you had set it up a few years prior when they were a child and then they sort of age into adulthood, that's a scenario where they do allow the parents to remain actually as a co-holder on the account. So that's something we sometimes like to do just so that the parents can continue to provide some advice and help out a little bit on the account. And now as the beneficiary is an adult, they're going to be co-holders of the account. Okay. So moving on then into the benefits of the RDSP. Obviously the big one is sort of the government money coming in. So we're going to start here with the Canada Disability Savings Bond, or the Cdsb. And for this one, for the bond, you don't need to put any of your own money in. Basically, if you qualify, the government's just going to put in money when you open the account. Okay. Here, you're eligible for the bond until the end of the year in which the beneficiary turns 49. And the maximum lifetime bond is $20,000. Okay. In terms of the bond and how much you're going to get, there is sort of a limit based on the family income. So if your family income, and the 2021 thresholds are here, if the family income is up to or equal to $32,028, the beneficiary is going to receive $1,000 into the plan in bonds. If the family income is over $49,020, they're not going to get any bond. And if the family income is in between those two limits, they're going to receive the bond, but reduced on a prorated basis, depending on their income. Okay, oops, there we go. This is, as I said, based on family income. So again, it's going to be a little bit different with children and adults. For children, the family income is their parents' income. Okay. For adults, it's their income and their spouse. So we've got a situation here where, again, if you've got a child who has a beneficiary, when they turn 19, their family income is no longer the parents' income, it's their own income. Okay, and when we're looking at the family income, the CRA is actually looking at the second preceding year to determine that. So for example, if your child is turning or has already turned 19 this year in 2021, ideally they would have filed their own tax return in both 2020 and 2019, because the CRA is going to look at their 2019 income to determine how much bond they get this year. And what that's going to do is, even if the parent's income is over that threshold, it's unlikely that, you know, most kids when they're 17, disabled or not, are going to be earning over this threshold of 49,000. Okay, so that's always something I like to recommend. The year that your disabled child is turning 17 and turning 18, they should be filing their own tax returns, whether or not they're earning any income. Okay. So that's sort of all to do with the bond. The other way to get government money into the plan is what's called the Canada Disability Savings Grant, or Cdsg. And so this one, you do need to put some of your own money in to collect matching money from the government. And again, it's eligible until the end of the year in which the beneficiary turns 49. For this one, there's a maximum lifetime limit of $70,000. Okay, so quite a bit of money can go into this one. And once again, there is a family income threshold under and over, but here this one is significantly higher. For 2021, the lower income threshold is $98,040. And in this case, if the family income is below that threshold, the grant money and the matching is extremely generous. You actually get a 300% match, or a 3-to-1 match, on the first $500 that you put into the plan in the year. So you put in 500, the government puts in 1,500, just like that. Then on the next $1,000 you put in, they actually match that 2-to-1, or 200%. So now you put in another 1,000, they put in 2,000. So you're in a situation where you've put in 1,500 of your own money, and the government has put in 3,500 of their money, plus potentially some bonds. Okay, So overall, very, very generous. You would ideally, as I had mentioned, the lifetime maximum is 70,000. So if you fell under this limit all along, you would ideally do this for 20 years, and the 3,500 times 20 years gets you to the lifetime limit of $70,000. Okay. If your family income is over that threshold, the 98,000, the grant is still very generous, just not to the quite to the same degree. Here you don't receive 3-to-1 or 2-to-1 matching, but you do receive 1-to-1 matching on the first $1,000 you put in the year. Okay, so still very nice to get an immediate 100% return on your money that goes into the plan. Well worth doing. Okay, so I wanted to look at an example here of someone who is sort of the best case scenario. This is someone who's been receiving the maximum bond and the maximum grant right from birth. Okay, and so what's happening here is that the family is contributing money for the first 20 years. They put in their 1,500 per year for 20 years. So that's why their contributions are $30,000. The government has put in their 3,500 for 20 years. So they've put in 70,000 in grant, and they've put in 1,000 per year of bond. So they've put in 20,000 of bond. And so what we've looked at here is a case where that family has invested the money in a balanced fund and earned perhaps 4.5% of an annual rate of return. So after 20 years, it's grown by another $68,000. Okay, so here's a case where the family's $30,000 of contributions has turned into almost $190,000 within the first 20 years, and that's all to be used for the beneficiary's long-term needs. And if they were to keep that money invested until the beneficiary is 60, it would be worth over $1 million, still originating only from their original contributions of $30,000. So you can see sort of just how powerful RDSPs can be and why they're my all-time favorite tool. You can really magnify a modest amount of savings into something that's really going to impact the beneficiary's financial life down the road. And yeah, so once that money is in there too, it legally belongs to the beneficiary, right? So it goes to them down the road. So many of you are probably saying, well, we haven't started from age 0, or, you know, I'm older than that, I'm an adult. How does that look? They do help you out here as well. There is sort of a 10-year catch-up mechanic that exists to help you out. So basically, if you've missed your grants and your bonds for the past 10 years, those still remain. You can still collect them if you act now, right? So basically, the bond is easy. It goes back $1,000 per year times 10 years. You can get up to 11 grand, right? The past 10 plus the current year in bond. And that could happen right when you open the plan if you had all of that catch-up room available. The grant is a little more complicated than that. Basically, they have both the 10-year catch-up rule, but it's also limited to 10,500 of grant money in a particular year that you can catch up on. Okay, if you have that grant room, they do actually help you out, though. They start with any available 3-to-1 matching first, because it's the highest available matching. Then they move on to any 2-to-1 matching. Then they move on to any 1-to-1 matching that you might have. Okay, so just as a quick example here of how you could catch up fairly quickly on your grant money, basically the math is a little complicated here, but you would work backwards. Originally in the first year, the government's going to put in up to 10,500. Well, you need to put in, or the government needs to put in then 7 years worth of their 1,500 of the $500 3-to-1 matching, right? So in this first year, you're only taking the 3-to-1 matching. You have to put in 3,500. The government puts in their 10,500, right? The next year, you've got a little bit less of the 5-year, or rather the the 3-to-1 matching, the $500, you have to put in a little more, $4,000, and the rest comes from the 2-to-1 matching. And then sort of beyond that, you've run out of your 3-to-1 matching, you've only got the 2-to-1 matching, you have to put in a little more to keep collecting the same $10,500. So again, sort of the math gets a bit tricky here, but the point is that in a short period of time, within 5 years, you can catch up on $50,500 of grant money, plus potentially the $15,000 in bonds, $11,000 in the first year, and then another 1, 2, 3, 4 going forward. Of course, it also is a little bit complicated because this is assuming you've been under that threshold all of those years. Your family income may have crossed up and down over that threshold. So the good news is you don't need to do any of that math yourself. The government will send you what's called an annual statement of grant entitlement every year. And basically that's just going to show you, okay, here's how much money the government could put in on your behalf. And this here on the right is the amount of money you need to put in to collect that maximum grant. So looking then at funding the plan, sort of beyond just grant money, because we've talked some about contributing, but you're allowed to deposit more money if you wish into the plan up to $200,000. There is a lifetime limit. And anyone can make those contributions into the plan. They just have to be authorized to do so by the plan holder. And the purpose of that is basically just so that the plan holder can plan around future grants and stuff. If you've used up your entire limit and there still may have been grant available next year, well, they want to avoid that situation, right? What's nice about that, though, is that you'll often have one person or the parents listed as the account holder, but in reality, it's the whole family funding the plan, or it might be family friends, or it might be a charity or whatever. You know, it's nice because they can all make the contributions. Arnold had mentioned in the intro that we have a family member and a family connection to RDSPs, and that's actually what we do. We decided quite a few years ago that for Christmas, instead of all buying each other gifts, what we were going to do is we're all going to pitch in $50 or $100 into this family member's RDSP, and that way we're easily reaching the $1,500 limit for the maximum grant every year. And it feels great knowing that for Christmas, we're helping them secure their financial future and really amplifying our money to help take care of them. So that's always an opportunity, something that can work out quite well. As I mentioned, once that money goes in, it legally belongs to the beneficiary. Okay. So other than that, you know, you can contribute that money. Other ways to get money into the plan would be potentially rolling money over from a registered retirement savings plan or a registered income fund or a registered pension plan, or rolling money in from an education savings plan. We'll look at those in a little bit more detail in a second. But before I do that, wanted to look at how do withdrawals work. And if you thought sort of the contributions and the matching were complicated, it's about to get even more so. There are tons of fiddly little rules, and it's very different based on the makeup of the plan and what's happened in the past with grant money and how old you are and all of that stuff. So it's definitely best to talk to your advisor about your personal situation before requesting any withdrawals. But we're going to go over some of those rules and sort of the usual cases right now. So they want the RDSP to be a long-term plan and have it be used for the disabled person's retirement. So to that end, what they've done is they've implemented what's called the 10-year assistance holdback amount. And basically what happens here is that if you're going to try to make any withdrawal, the ESDC, the Employment and Social Development Canada, they're going to look at the plan and say, okay, have we contributed any money in the past 10 years? So if the government has put in any grant or any bond within the past 10 years and you make a withdrawal, that grant and bond is subject to being clawed back. Okay, basically they don't want you to contribute money one year collect a bunch of grant money and then immediately take it out and spend it. It's supposed to be a long-term thing. So they're actually going to claw back $3 worth of grant and bond for every $1 redeemed if they've put money in the past 10 years. So I really can't stress that part enough. If you went and requested a withdrawal for 10 grand and you haven't been careful about the 10-year rule and sort of planning around that, that $10,000 withdrawal could cost you $40,000. Okay, so very, very important that you make sure you know the rules surrounding this, and or that you're making sure you're consulting with your advisor and that they know the rules, because you could be facing very hefty penalties if not. So if you recall, those grants and bonds were actually able to be paid into the plan up until age 49. So the safest thing to do is actually to wait 10 years after that and start withdrawals at age 60. And that way there can't be any grant or bond. You won't be able to run into this because it just wouldn't be a factor. So those withdrawals would be in one of two ways. If it's a one-off payment, it's known as a disability assistance payment, or if it's sort of an ongoing annual thing, it would be a lifetime disability assistance payment, or LDAP. Those, once you've started the LDAP, the lifetime payment, those have to continue going every year until either the plan has run out of money or the beneficiary has passed away. Okay, and those LDAPs, that also has to start at age 60. You don't have a choice there. Once that money has come out and made the withdrawal, there aren't any restrictions on its use. It belongs to the beneficiary and they can spend it however they want. The one case then where the assistance holdback rule might not apply in the 10-year rule is that there are special considerations if the beneficiary has a shortened life expectancy. So we won't go too far into that. Just know that if a doctor has told them that it's likely they'll pass away within 5 years, most of these rules, there's a whole different set. You can get more money out a little bit quicker in that case. Okay, so beyond then just the 10-year rule, there are further restrictions and more rules based on how much you're allowed to pull out and how much you have to pull out. There is both a minimum and a maximum at different times. So starting with this first table here for beneficiaries under the age of 60, there is no minimum withdrawal at all. You don't have to start pulling money out of the account. Okay, if you do want to, how much you can withdraw is actually dependent on whether or not the plan is what's known as a PGAP, or a primarily government assisted plan. So basically that's just saying if the government has put in more money than you have, it's a PGAP, it's primarily government assisted. If you have put in more money than the government, it's not a PGAP, right? So if the government's put in more than you, they're actually going to limit how much you're allowed to withdraw before 60, and that's going to be limited to 10% of the plan's value at the beginning of the year, or the LDAP formula, that doesn't really apply until you're in your 70s. Okay, so it's going to be 10% of the plan value, but still subject to that 10-year assistance holdback rule. Very important. If, however, it's not primarily government assisted, so you've put in more, there isn't a limit. You're allowed to pull out however much you want from the plan, again, subject to that 10-year rule. Okay. When you turn 60, though, the maximum is basically the same. They've just also introduced a minimum. Now you have to start pulling out at least as much as the LDAP formula says. We won't get too in-depth about what that formula is, but basically at age 60, it's going to start at about 4.5% of what's in the plan, and it's going to increase on a percentage basis every year until you're in your 80s. Okay, so then again for the maximum, here there is a point in your 70s where that LDAP formula is going to exceed 10%, but otherwise it's the same. So hopefully I haven't lost you too much. Like I said, there are a lot of different rules. It's a little bit fiddly, and it's very dependent on your individual situation. The bottom line is probably talk to your advisor before deciding on what your withdrawals are going to look like, because you don't want to sort of screw that up and get things wrong. When you're making those withdrawals, then those are somewhat taxable. The way that works is basically the money in the plan is going to be split up into your contributions and basically everything else. And your contributions are able to be returned tax-free because you were taxed on it before you put that money in. Pretty much everything else is going to be considered taxable income to the beneficiary. And they're not able to choose which proportionally they pull out. It's just going to be proportional to the amounts that went in. So if, for example, 10% of the plan value was original contributions, then any withdrawal, 10% of it is tax-free, 90% of it is taxable to the beneficiary there. One thing that's really, really nice about RDSPs actually is that any income derived from the plan, it doesn't impact any other income-tested federal programs. So basically, the RDSP income doesn't count towards the thresholds for lowering your old age security payment, doesn't count towards the threshold for lowering your CPP payment or your guaranteed income supplement. Same goes for the GST benefit, lots of social assistance benefits, and most provincial programs fall into the same category. So yeah, taxable income, but it doesn't count towards those income tested programs, which is really, really nice. Did then want to look at a case study of a RIF rollover. So what we've got here, and this is going to work the same whether it's a registered income fund or an RRSP or a registered pension plan. And what we have here is we've got Sarah, who has $500,000 in her registered income fund. And she's got a disabled son, John, who's financially dependent on her. And so if Sarah were to pass away and she hasn't done anything, her estate pays the tax on the RIF. And we're assuming she's in the top marginal tax bracket. In BC, that's 53.5%. So the estate's actually going to pay tax in the amount of $267,500. If instead she had designated in her will that she wanted to do a rollover of $200,000 into John's RDSP, so that's up to the lifetime limit. Maybe he's in his 50s and can't collect any grant or bond anymore. So 200 grand goes into his RDSP. Her estate now only pays tax on the remaining 300 grand. We've just saved the estate $107,000 in tax right up front. Okay, now that 200 grand in John's RDSP, that is still going to be eventually taxed in his hands, but the likelihood is that he's going to be in a lower tax bracket than the top marginal one, and he has the opportunity to spread that taxable event over many, many years, right? So if he's paying something closer to 20 or 30% tax, he's only paying 40 or 60 grand in taxes instead of this 107 that Sarah's estate would have had to pay. Okay, so that can be well worth doing. It's a little bit situational. This kind of rollover is only going to work for parents or grandparents of the beneficiary, and it has to be designated to happen on death. So in the will, and the beneficiary has to have been financially dependent on them. So like I said, a little bit situational, can be well worth doing. The other kind of rollover we can look at is actually the rollover from an education savings plan, an Resp. So let's say you've got a disabled child with an Resp and they don't end up going to school. Normally the Resp grant and the bond have to get clawed back, and that's going to be true either way. But you also then have to make a decision about the investment income in the plan. If you have RSP room, The parents can then roll the accumulated income payments into their RSP. Or if not, they're facing a situation where that income is taxable to the parents and penalized at a further 20%. So the benefit here would be that instead, if that beneficiary of the RESP also is the beneficiary of an RDSP, they've got an option where they can roll the income into the RDSP instead. So now instead of being taxable in the parent's hands, it's eventually taxable to the beneficiary. And it avoids that 20% penalty tax, and the original contributions of the education plan are returned to the parents tax-free. If they want, they can still be deposited into the RDSP to collect grant money. And those conditions for the accumulated income payment are that the beneficiary won't be pursuing post-secondary education due to the disability, or that the RESP has existed for at least 35 years. Okay. So wanted to look at then, what happens if the beneficiary dies or loses the tax credit. So far, everything's been sourced from that Canada government website, but did sort of want to take a look at that and what is going to happen there. Basically, if the beneficiary loses the DTC, and this is a question that comes up quite frequently, sometimes that disability tax credit, they offer it to you permanently. Other times it expires and you have to reapply after 5 or 10 years. So I just wanted to look at what happens if you don't get reapproved and you've lost the DTC. A few years ago, the answer actually would have been different. Before 2019, you would have actually had to close the RDSP. You had a little bit of leeway time to do so, but you would have had to close it, and grants and bonds paid within 10 years would have had to be repaid to the government. Now they've changed it in 2019. It no longer has to be closed. You don't have to repay the grants and bonds. It's sort of a much better scenario. Hopefully you're going to get reapproved for the DTC down the road, but in the meantime, the RDSP can just sit there. When that happens, though, the RDSP is sort of locked in a way. You can't continue making contributions to it. You don't continue collecting grant money. You cannot do the RESP rollover, but you might still be able to do the RSP or RIF rollover. That's allowed if it happens within 4 years of the end of the year they've lost the DTC. Okay, so it can be worth looking at and doing that. Then also what happens when the beneficiary dies, or if they unexpectedly die and they still have, the government grant money. That's where the RDSP does have to be closed by the end of the following year. Any grant and bond money paid within the past 10 years does have to be returned to the government, and the rest is going to go to the beneficiary's estate. So because of that repayment, if you know that there's going to be a shortened life expectancy, it can be worth it to pull out some money while the beneficiary is alive. Like I had mentioned, there's sort of a different set of rules that comes up if they're expected to pass away within 5 years, and that would be considered a specified year, and you've got some other options. Okay, so that's sort of mostly it for content. I'm going to see if we've got any questions here. I hope so far this has given you a pretty good understanding of what the RDSP is, how it works, who can benefit, and sort of just how valuable they can be. In my opinion, everyone who can open an RDSP should have one. They're phenomenal tools. If you're looking to open one up, I would suggest you set up an appointment with either your bank or your financial advisor. We're happy to take on new accounts and chat about that as well. Just again, though, I would make sure you do ask your advisor about their familiarity with the plans. Make sure they know all of the rules. We've heard tons of horror stories that we don't need to go into right now. But of course, we're always happy to help. I absolutely love setting up new RDSPs. It's my favorite thing to do. So do feel free to contact me or pass along my info if you know of anyone who might benefit. So like I said, we're going to move on to questions. Please feel free to post them if you haven't already. If your question isn't answered, or if you want to talk about your situation personally, I'll leave this on a screen with my contact info. My email address is ben@visionvest.ca. You can give me a call at 604-542-2818. And we'll also have a replay available on our website, visionvest.ca/videos. So on to questions. Does anyone have any? I see one that someone had posted. What happens if the beneficiary no longer qualifies for the DTC? I think we went over that. Are there any other questions? Looks like maybe not. So I will say thanks again, everybody, for attending. I hope you found this valuable and worthwhile. Do feel free to give me a shout if you've got any follow-up questions or want to talk about your situation personally. I'm quite happy to chat and talk about that. So we will sign off for now and say goodbye. Thanks, everyone.